Welcome everyone. My name is Daniel Flatt. I'm the contributing editor at Regulation Asia. And as Manish said on the prior session, this is a panel discussion concerning liquidity risk during a crisis. As a result of COVID-19 and the actions taken by governments and businesses to help mitigate the impact of the pandemic, banks and other financial institutions have found themselves under a degree of pressure to manage and report on their liquidity positions and funding capabilities. Regulatory requirements put squarely in place after 2008 were designed to improve banks' ability to meet funding obligations by establishing liquidity buffers and to implement contingency funding plans, CFPs, to guide banks during times of such crisis. However, as you are all very acutely aware, equity market volatility, liquidity tightening, widening funding spreads, operational fails, and other challenges across the board have placed additional pressure on bank liquidity risk management, at least for certain institutions. Much has been done by sort of government and government bodies, the US Federal Reserve, for example, to stabilize financial markets, large-scale asset purchases, for example, while regulators extended timeline for certain regulatory requirements, such as the current expected credit losses implementation, in an effort to reduce some pressure on bank resources. And this has, by most accounts, been relatively successful. The capital and liquidity buffers that banks now have in place were designed for similar black swan events as we see now, to ensure they can support the economy during these trying times. According to a recent report by Deloitte, many banks across the globe have activated their CFPs, and as a result are having to report their liquidity positions to senior management very, very regular intervals. It's in this area around bank liquidity risk management where, you know, a series of interesting issues have surfaced. And with me today to discuss the pain points and observations, and hopefully to provide some guidance on how to overcome them, very pleased to have with me Yves Tomballe. He's the Chief Risk Officer Singapore for MUFG Bank, and Nadeem Shamim, who is the Head of Cash and Liquidity Management at Smartstream Technologies. Hello, guys.
Hi.
Good day.
How are you doing? Good. All right. Well, I'll start off with you, Yves, with a question.
Sure.
In your role and as a sort of CRO, how would you define the last sort of 7-8 months? How has COVID-19 affected you?
Well, I think what we've seen at the beginning is clearly clients kind of shoring up liquidity. This happened more around February to April, where we saw some drawdown on committed line that was just a reorganization of cash flow across our clients. This, fortunately, we haven't seen, and I've shared this opinion and I've discussed this opinion with a few other treasurers. I don't think we've seen a major drawdown on liquidity that has led to anything similar to what we saw 10 years ago during the great financial crisis. This actually, I think this is something we can discuss, whether this is related to the new measures that were put in place after the crisis. But clearly, this wasn't the case this time. The government, the central banks, were clearly ready to intervene, and they've been again flooding the market with liquidity if necessary. And overall, there hasn't been a sense of panic that would have led to something that we saw before. We've seen a small spike in interest rate, but again here rates have gone back down. The situation is fairly controllable there, and I think overall liquidity situation within major financial institutions is I believe manageable, and if anything, the flags that were raised a few months ago are now starting to be discussed to be brought back down to more I would say normal to regular level. Yeah, so that's what overall I would say the overall liquidity picture that I see now.
And has there, I mean, that's good news essentially, but has there been anything from a sort of just a practical perspective that changed for you? Have you had to sort of operate in a different way? Obviously, there's been social distancing, etc.
Sure. Sure. I mean, very pragmatically, we obviously had to discuss how we were going to do, how traders were going to operate in this environment, having to send obviously a good part of our staff working from home. So we have prioritized, of course, the essential staff to continue to work from the office, the ones that are doing the operations. We had to discuss how we were going to do rate submissions to LIBOR, to SIBOR here in Asia. And we had to discuss how to make it work. So we had various discussions with the right regulatory bodies on this. So we had to make some decisions. It was about, having a strong local top-down management ready to take pragmatic actions quickly. So that was important, I believe, to have a clear differentiation of role between regional management and local management in this sense, to take the necessary decisions. But overall, I'd say it ended up being quite smooth. We haven't witnessed any particular incident in that sense, and most of the other either risk manager or treasurers that I've talked to have been able to continue smooth operations accordingly.
You mentioned definition of roles between regional and local firms. So can you just sort of expand on that, if you don't mind?
Sure. Well, I think it's particularly important. We know many of us work in matrix reporting framework here as regional quarters, usually in Singapore, whether in Hong Kong, Singapore. And these types of crises really stress this matrix reporting framework. So it's important, I believe, to make sure that in times of crisis, you have the right reporting line, to make sure that the right people are accountable for the right risk, and to make sure that swift decision can be taken in these extraordinary circumstances. So obviously, I take from my own organization, and we managed to do that quite well. I was really happy about our environment. We've had a local CRO, framework for about 2 to 3 years now, and I believe this has made the overall framework, localizing the framework, has made it different from having a more regional-only framework that doesn't always provide you that kind of support.
I want to take you up on the point about sort of GFC regulations. But before I do that, I'll just bring in Nadeem, just to in your role and the conversations that you're having with I assume sort of treasurers or similar type executives. What's the feedback been on the back of the pain of COVID-19?
I'd like to echo what Yves said in terms of the challenge of actually liquidity itself. Yes, initially there was concern around whether there'll be sufficient liquidity or not. But then you've seen a number of regulators have pumped a huge amount of liquidity into the market. They've encouraged deferring of dividends and the requirement on potentially some of the regulatory reporting around stress testing as well. So it's made a lot easier for the banks to manage their liquidity from the numbers perspective. Where they found more of a challenge is more on operational levels, because the majority of the people are not able to work in their offices. They're dispersed, whether they are in their back offices in the same location or in different countries. The number of people that are available to work has reduced to some extent, which has meant that when they are preparing their daily liquidity reports, for example, there is a bit of a lag. So there is a concern that has been raised that it could be that the information they get on liquidity reporting itself is not up to date. It's not 100% accurate. So there is a potential risk around not having the most accurate information to make those liquidity decisions. What that has meant is that they've just ended up leaving additional liquidity on the account, effectively wasted liquidity.
Well, Yves, I noticed you were nodding at that point. Do you see some your own experience of something similar?
No, I mean, totally agree with your point, but I think this is beyond the crisis itself. I think intraday visibility on liquidity has been a long debate that has been, I believe, driven by, many hoped this would be driven by a regulatory push, and we've seen this push to a certain extent in the US, definitely, Europe to a certain extent, in Asia. It's still lacking traction, and considering the significant investment that it requires, it is usually having a regulatory push helps you allocate the budget to go into that direction. But obviously, I think thankfully the liquidity situation being fairly stable, and as I said earlier, the small spike that we saw and that small liquidity request that we saw in the market was fairly short-lived, and therefore we didn't need too much a buffer to take care of that extra volatility. So overall, I think it all played well. But that problem is, I think, a recurrent problem that we will need to tackle at some point.
Okay, and Nadeem, I will pick you up on and explore further your point about operational issues, but I do really just want to cover possibly more out of my own sort of curiosity than perhaps anything else, which is we've talked about the regulations that came in, post global financial crisis that were essentially, to some extent designed to sort of handle these types of events. But as we're all very aware, we're still fundamentally reliant on central banks, government regulatory support. Has to some extent, has all the sort of preparation been put in place? Has that really been tested to the extent that perhaps you would imagine, given the sort of disruption that we face? I'll put that to you, Yves.
If you're talking about the regulations that followed the great financial crisis, if this is what you're talking about right now, I don't believe that we've been able to really test LCR the way it was intended to be tested. The central bank was supposed to leave the market a long time ago. Unfortunately, this never really happened. If anything, they've been increasing assets on their balance sheet. And this is unlikely to go away anytime soon. So, except for maybe a few situations in a few countries, I think most financial institutions did not have to rely on their HQLA to shore up their liquidity situation, which means that, we haven't really been able to test what LCR was really meant to deliver. Again, what remains to be seen is whether the sale of HQLA works as a tool to obtain liquidity in a short amount of time. And the selling process has never been really tested at large scale. And while if you look at Asia, most of the HQLA is really comprised of government assets. But in Europe or in the US, a part of that HQLA can be made of corporate bonds to a certain extent. So it remains to be seen in a situation, in a real liquidity crisis, what the haircut is going to be on these types of securities. But again, we have not been able to witness that here, I believe. Interesting.
Yeah. So I suppose to summarize that point, it's very difficult to know whether what we've been preparing for it is actually sort of suitable for the situation. Nadeem, the conversations that you have, what sort of sense of urgency do you get from clients? Are they anxious to be ensuring that they've got the visibility on where their cash fundamentally is, or where they can get hold of it?
Yes, it is becoming more important, and certainly on the intraday liquidity, the conversation is getting a bit more active around understanding exactly where is the liquidity, not just where it is, what is the liquidity that they have, where are they expected to have a liquidity crunch during the day. It's all very well saying at the end of the day, my book is square, but what if your liquidity crunch happens and you haven't received sufficient amount of credits from your counterparts? How do you ensure that your obligations are met on time and without any delay? I mean, that has a significant impact on various other elements. But so that's becoming more of a conversation with our clients. The other conversation that is being more actively is that they're more interested in finding out how can they do the stress testing element more efficiently. I know we're going to touch upon that a little bit later on as well, but I think that is what used to be, and in some cases still considered, a regulatory burden. They're seeing the value of that on a BAU process, provided that they have a process in place that they can move the levers around to see what impact these changes have on the liquidity itself. For example, you start stressing a certain counterpart or a certain correspondent bank, or the available liquidity on your balance sheet, or the impact of collateral and the market value of that collateral. How does that change the liquidity? And because the situation is unique in some ways, to Yves' point, we haven't really tested the old regulations that have been put in place and the framework that has been put in place, because it is a unique situation. It's not what was last time. So there isn't a formula or a guidance on how to address this. So they need to be able to test different scenarios more effectively, more efficiently, and more rapidly.
Okay, well, carry on that point. So how are they doing that? What methods were they applying, and what questions are they asking to handle this when in terms of stress testing?
Is it to me or to Yves?
To Nadeem.
I'll carry on. All right. So and I think Yves would be able to tell more directly from his experience as well, is that the standard was, yes, let's set up the BCBS 2484 scenarios, and the focus was usually on own stress or counterpart stress. The rest were very difficult to put in place, to be honest. It's very difficult to say what impact it would have on my liquidity depending on the market, because that just becomes using analytics to potentially predictive analytics, machine learning elements of it. But it was more operationally focused around the impact of changes in available liquidity to me, or the lack of funds coming in. That's an easy one to manage. Mm-hmm. Once that was put in place, it was almost operational. Do it once a month or once a quarter, it was done and dusted. Now, if I was talking to another large bank only recently, and they said, okay, we've got a good process in place, but if I need to change one of the elements of this particular stress, for example, change a certain counterpart, which is delaying payments, it can, the amount of data that needs to be modified and the sources that need to be modified, it can push back my reporting of that stress by up to 7 to 8 weeks. That is not dynamic enough, quite frankly. It doesn't help the Treasury team to actively address, or the risk team to actively address, the impact of rapidly changing environment.
Yves, in terms of stress testing, how have you sort of operated in this environment? Any changes, any different sort of approaches, any slight ticklish issues that you need to iron out?
No, we've taken into account, as we always do, the volatility in the market, and we've expanded that, extrapolated that to see how a portfolio would react. But again, when we saw early on that the signs of stress were fairly manageable, and we were not looking at the crisis that was going to derive towards what we saw 10 years ago, we were confident that the model that we had in place would allow us to see the crisis through. And we continue to obviously monitor very, very closely the liquidity situation across the globe. I think what's particularly important right now, beyond, I would say, short-term funding liquidity, is funding diversification, because that has a more long-term impact, and it's harder to steer when you're taking a wrong direction than I would say short-term liquidity, where we see that in the short-term liquidity we still have a very, very liquid and ample market. There, I think stress testing, concentration monitoring is very important. I hope, and we've seen the government, Singapore's government, starting to issue longer tenors as well. I'm hoping that the market in Asia will continue to become more liquid, so that treasuries across the globe can better diversify their portfolios, and ensuring to have both a regionally optimized portfolio, but at the same time sufficiently liquid locally to meet regulatory requirement and local needs.
I certainly wasn't expecting to sort of say this during this session, but it seems that what we're facing, at least from what I get from you, is another perfect opportunity to adapt and evolve without necessarily the huge impact of a proper liquidity crunch. There is support, there is good guidance, there is at least some clarity. It's a good chance to keep testing the situation. You mentioned obviously funding diversification. I take from that comment that perhaps there are financial institutions that might be holding, I don't know, I'm guessing, but a lot too much corporate debt or something like that. Is that what you mean?
Well, that's more around the asset allocation. I'm more talking about how you're funding your book overall. As we see right now, actually, volatility in deposits, you can end up with concentration of deposits with certain names, certain currencies, where you need to be particularly careful on how you're going to use this. Again, the lending market right now, we have to be particularly careful. The impact of COVID-19 is still unclear. The length of the crisis is still unclear. Many names might end up facing difficulties in the future, and it's not yet obvious. So we have to be extra careful when lending out in the current environment. And obviously, we need to be there for our clients. We need to analyze this carefully, but at the same time, continue to be long-term partners with our clients. So this analysis is particularly important. And therefore, how you're going to allocate the funds you receive is even more important. We know we are in a low interest rate market that is likely to stay like this for the next probably 5 years, which means that the curve is also going to stay fairly flat, if not inverted in some areas, which means managing your net interest income is extremely important as well. And that's where I believe the importance of funding diversification, I would say curve management, cash flow management is particularly important.
Okay, thank you. Nadeem, when we spoke a few days ago, you introduced to me sort of 4 major sort of observations, I think, that you saw from the sort of COVID-19 around, you've already sort of covered a little bit the intraday reporting. I think you mentioned issues around knowledge gaps, credit risk, and stress testing. Could you take me through that again? Because I thought that was very interesting, those sort of 4 components, and just your broad observations on that.
You put it down to in 2 groups, I would say. One is around operational side of it, right? So the knowledge gap is quite visible from what I see and from what I hear when people are not sitting together and there are juniors working on a particular task. If they get stuck, they don't have somebody readily available. They have to actually reach out to a colleague through Teams or another electronic channel, as opposed to just get up and walk and ask for help. So that knowledge gap means that again, collation of data and making it useful information is slower, and there could be some errors around that as well. The other element is more about the regulation and the reporting as well. So for the BCBS 248 reporting, the challenge has been around, again, gathering data and getting the information correct and having the timely information around it as well. Now, the issue around stress testing is that I think we touched upon that already in terms of saying, where exactly the impact would be on my liquidity itself. So Yves mentioned about credit risk as well, and we don't know how long this particular scenario will last. And if large elements of your credit book starts to default, that has a direct impact on liquidity itself as well. So that there is interlink between credit risk and liquidity risk. So I think those are the key components around that as well.
On the issue of sort of stress testing, we've actually had a question come in from the audience, so I guess it might make sense to sort of bring that in. I think the question is essentially, do you know, or does anyone here have an insight into how the regulators are going to design new scenarios for stress testing? So I guess any indication of how one might go about this is that something you can answer, either of you two?
No, there hasn't been any visibility on this at this stage. We haven't had discussions on that. Again, COVID has turned out to be an extremely unpredictable crisis, and it's very difficult at this stage to be able to see how this will impact liquidity going forward. I believe what the change that I've seen is that regulators are a lot more hands-on in managing the banking exposure. I've never had so many meetings with regulators than now. We've moved from, I would say, more formal meetings where we would have a particular subject that would be discussed, prepared a couple months in advance, to having almost bi-weekly meetings where we're discussing ongoing situation, ongoing exposure, questions around it, which is great. I mean, it allows us to have a lot more nuance to explaining the situation and develop a stronger bond with the regulator. But at the same time, it's also very taxing for regulators. I don't know how long they will be able in their current resources to manage this amount of scrutiny. Again, an area where I believe technology will help in the future. We're still very much in an environment where the regulator sends you, requests for data, and we react and provide the data, usually in very, ineffective formats, spreadsheets, email, documents. I hope that the next 5 years we'll see a leap forward in technology where regulators will be able to just use an API and plug into a read-only framework of financial institution, read the data that they need to read and run the scenarios that they want to run, and then have discussions around the results. If we want to have a more dynamic framework that is able to analyze more quickly these types of crises, this is where we need to go. The technology is here. It's just a matter of finding, I'd say, the industry standards that all parties are comfortable working with, and then choosing that technology and moving forward. And I'm very, very strong that the MAS will probably be again, MAS in Singapore will probably be again one of the leader in this space going forward.
Yes.
Yeah, please.
Just to add to that, I think that there is a lot more conversation going on inside the organization because there aren't any specific guidance in terms of or regulations coming down the line, which says the stress tests that you need to carry out are X, Y, and Z going forward. Banks are now looking more and more to say, how can they create the what if scenarios? What if scenarios are becoming more and more regularly used than it used to be to carry out stress tests, and different elements of liquidity is being stressed. And it used to be, again, you look at the LCR and SFR, which was being looked at. Now it's going further, shorter period, going into intraday liquidity as well. So they're looking, to Yves' point, they're looking more and more towards technology to see how can they help this linear element of it, but then also how the newest technology, the likes of artificial intelligence, machine learning, can actually add value or provide them with tools to have a more flexible way of understanding what's happening to their liquidity. Granted, that is a little bit further down the line, because nobody in a financial organization wants to purely rely on machine learning and AI, because it's still seen as a black box, especially when it comes to regulatory or stress testing around it.
We don't have to go this far. As you said, right now, if we could already shorten the time between the moment a regulator comes up with an industry-wide scenario and gets the result, that would already be a major improvement. Right now, it takes a regulator probably 6 months to get the results, and those results might even be based on data that was already 3 months old.
Yeah.
So you're talking 9 months. We're in a different world. And just because of the way data is produced, you have to leave banks 3, 4, 5 months to produce the results, because it has to go through, I don't know how many committees to get approved, to get verified. We need to do something there to not so much working on the quality of the scenario, but much quicken the pace of results, so that we can just run more scenarios, which will dramatically improve the results.
Yeah, which is you just validated my point early on, saying that the time it takes to prepare scenarios is quite long, and especially if you start making changes to the scenarios, is very difficult.
And the scenarios then depend on that as well, because people are very scared of using a scenario that is too extreme. If they know it's going to take 9 months to get a result, so you end up coming with very consensual scenarios that are mostly historically based on the recent events, in major countries, and you end up with a result that is not much further from, the current parts of the current environment, and not really what I would call a stress scenario. If anything, it's just a slight extrapolation of the current environment. Yeah,
I think you need to have a tool that says, right, I defined what my liquidity pool is, and that can vary depending on my test that I want to do, and then look at what the different tests there are, whether that's reduction of lines or delay in payments, or at some change in market value, or ring fencing some of the liquidity. And then you can apply filters to say, how do I change the filters around it? It needs to be more flexible, more user enabled, as opposed to here's a piece of paper defining my scenario. Send it to back office, they'll bring it back, as you say, Yves, 8 months later, you might get something.
And this is not just for the relationship between the regulator and the financial institution. This is also important between the financial institutions and their clients. We're also currently in a fairly similar data relationship with our clients, where we will request a lot of information before the inception of a transaction. But once the transaction is in place, it's a lot harder to run a stress scenario on an exposure or getting sufficient data, because that kind of flow of information is not available. If financial institutions were to develop tools made available to their clients to manage their liquidity, it also provides them with the visibility on the data to better anticipate future cash flows. At the same time, provide products to the clients by having a better visibility on the future cash flows, and at the same time having a much better understanding of the cash flow profile of that client. So it's a win-win situation where technology can play a major role, and that's where we have to be very careful, especially incumbent institutions have to be very careful, where digital challenger banks right now have a huge leap forward in technology. That's where they're aiming at, and where the incumbents have to be very, very careful to continue to invest in that direction if they want to stay relevant.
So in terms of I get the sense there's a bit of a sort of disconnect between what happens now and what your vision is. And you mentioned that it doesn't need to be necessarily as complicated or as futuristic as some might expect. But what is actually, has there been any sort of indication or any sort of advancements where you're seeing the capacity to disseminate information a lot faster? Has there been anything in your institution where you've seen, this is working better, this is a product of technology, and we're making we're seeing positive results?
Well, I think all institutions are investing, regularly in improvements, and I'm not going to talk specifically about what we're currently doing, but what I continue to see overall in the industry is that large investments, I would say bold investment that require large top-down decision, are usually, unfortunately, regulatory driven. When you have to make a big change, you need a large regulatory support to be able to justify the investment. And at the moment, that regulatory need, a requirement is not there. You're not being forced by a bank to invest in a particular platform or technology, because I don't think we have a common understanding yet on what that platform would be.
Okay.
So what banks can do right now, of course, is to, I would say, invest on their core infrastructure, simplify their core infrastructure to be ready when that technology will be requested by regulators. To have a sufficiently flexible enough platform so that you can, plug yourself to that requirement going forward, so that down the line you don't have to come up with a patchwork investment that's going to plug inefficiently to your technology, but you have a platform that is sufficiently recent enough and flexible enough that you can, implement this quite smoothly within your organization.
I'll bring you in a minute, just Nadeem, because I want your comments on that as well. But I'm thinking about it. How, or is it necessary, but how often are you communicating with your peer group? So you mentioned the regulators, and I always assume regulators are a pretty good sort of nexus for what's going on in the market. But how do you find out what another CRO at a different institution is working on? Do you have any insights there? Do you think it would be valuable to have a better level of communication amongst people at the front, the front line?
I can only talk for myself. There are a series of I would say, forums and platforms available for CROs to discuss ideas. We have the Asian Risk Council here in Asia, where we meet most of our peers. There are different opportunities to do so, but again, the regulator here can play a role, associations can play a role, and Singapore is again an example in that area, because of the ABS is playing a huge role there on bringing the organization together on deciding what the next technological investment and step forward will be. So yeah.
Nadeem, your thoughts?
Just touching on the previous comment, I think it's all around data. You need to have, I think banks need to start investing to make sure that they have tools available that gather all the data into one place. So it becomes a single source of information, be it for your day-to-day operational requirements, be it to stay within internal policy guidelines so you can be alerted of any breaches, be it to get warnings if you are holding excessive liquidity, which could be in effect due to a fraudulent transaction or an erroneous transaction as well. Because the current challenge you've mentioned as well is that around legacy systems that major banks are impeding the timely and accurate reporting. Now, that is a big challenge not only for short-term liquidity, but also intraday liquidity, near-term liquidity. And if you have the data, guess what? Then you can actually bolt on to all the new technologies around it, whether that is using a state-of-the-art stress testing tool or using machine learning and predictive analytics to say and predict what time the unsettled cash flows during the day would be settled. So you understand where the liquidity crunch points might be, or potentially failed payments as well. And it's all around it. So I think banks need to invest in a technology platform that brings all the data together, that actually puts a ring fence around the risk of not having the right information, and you can build on it as and when, and you mentioned that, as and when the regulators come with a new regulatory requirement. If you've got the data in place, guess what? You can actually deliver those requirements more effectively and more quickly.
That sounds... No, Yves, after you.
No, just saying, of course, having the data is absolutely paramount. But also having a system that delivers that data in different format quickly allows you to play with that data effectively. And we've seen countless examples of systems that weren't built to provide a certain data in a certain format, and we end up having to bring in another new system to chunk that data into another format. So I mean, these are all,
yeah, you need to be able to get real-time reporting at the end of the day.
These are all old topics that we've talked about in many areas. Obviously, technology, the technology is there. I think now it's more about finding a standard that works for the community, for the investment community, the financial institution community, and move together towards that.
Are there any other reasons why this hasn't happened? Because what you were describing, Nadeem, certainly sounds sensible and I wouldn't say intuitive, but somewhere around there. But it hasn't happened, and I've been speaking about this subject for long enough as well. It doesn't seem to have developed too far. So why not? I mean, Yves hit the nail on the head. There hasn't been a regulatory imperative to get that information and use that information more effectively. It's been the requirements have been a little bit delayed, deferred. You don't really need to report in real time basis because the requirements are you do on a quarterly basis or on an annual basis. Well, and usually by the time delivered, you're several months down the line anyway. So as the regulations, well, let's see if that does happen, change that you need to report on in real time basis, I think the focus will change. Absolutely. Okay. Unfortunately, I think we're sort of just about out of time, and I thank you very much for both your input and insights. I just have one sort of quick question. Is based on your point, Yves, earlier on about basically, government supporting the system. If that was, I know it's perhaps an unfair question, but if that was all taken away tomorrow, would we be in a very serious situation?
Well, this is really obviously extremely hypothetical. I believe that we are in a much better situation than we were 10 years ago. The overall relationship between front office, middle office, back office has completely changed. There's much more equilibrium between the front and middle. Therefore, the focus on liquidity has increased. Liquidity buffers have been shored up to levels that we have never seen before. Leverage is much lower than what it used to be. Prop trading is not what it used to be. Black box portfolios are not as prominent as they used to be. So we're not likely to see a liquidity crunch like we saw before. But in the hypothetical situation where we were to have another Lehman, I think clearly that LCR helps because instead of central banks being forced to lend unsecured in the market, they'll be able to repo out most of their transaction, which obviously puts a lot more security in the overall market and stability in the overall market. What my question mark remains, as I shared earlier, is in the ability to transform your HQLA into cash in sufficiently short amount of time that you can sustain the liquidity crunch. That hasn't been tested, and again, I hope we don't have to ever test it. But overall, clearly, we're in a better situation than we were.
Nadeem, just 30 seconds from you. Would you sort of, what's your point, your view on that?
Well, I think because the regulators have flushed the market with so much liquidity, they've not really had to test the liquidity at all. I mean, let's face it, if it gets pulled away, you've got the buffers in place. That's what they're there for. They'll be challenged. And let's see how quickly they can use that. I think it is totally hypothetical.
I know.
Banks, they've not stepped away, and they wouldn't. It's politically incorrect for them to step away.
And to be fair, the system wasn't built for them to step away. HQLA, by definition, requires the intervention of central banks to transform these assets into cash. So it was never the intention of completely stepping away, but more into, I think, responsibilizing institutions into shoring up the liquidity, so that they have a pool of high quality assets ready to be invested, and therefore make them more accountable for their liquidity position. And I think that definitely has worked, and we've seen how stable the market has now been. And now central bank have this tool of saying, look, we're going to provide the liquidity, but be careful. We could request for these HQLAs. We're going to manage our cash flow a bit better.
Very good. Gentlemen, thank you so much for your time. It's really appreciated. All the best to you.
Thank you.
Bye-bye.